Hey guys, welcome to this video. In this one, I'm going to cover the New Zealand dollar against the US dollar in a full multi-time frame analysis. Don't forget to get my free training underneath this video and like, share, comment, subscribe. If you're watching on TradingView, of course, remember to follow me. So I'm just going to kick things off on the highest time frame that I normally use. We've got the data again from 1971 to today, 52 years or so. Massive decline through the 70s into the 80s, continues for the 90s, and then you get this pull up, okay? And that pull up off from this enormous fall on a very long term scale took you just beneath your 0.5 fib level and just over your 38.2. So perhaps 43, 44, 45% of a retracement. Fairly reasonable. And then, of course, soon enough, you fell down. And the point you're at now is where you are running to these key areas of rejection / price action. Okay, that has been a very contentious level for a long time. Now, I would say from a economic perspective, the difference between the Fed Reserve and the Bank of New Zealand, okay, you can see from about 2017 to 2020, there was a flattening in the interest rate in the New Zealand dollar, and there was a rise in the interest rate of the US dollar. And that's why you had this fall here. But overall, the trajectory has been one of a downtrend where people are pulling their money out of the New Zealand dollar and putting it into the US dollar. Now, you had a similar move for many US dollar pairs around this point anyway, but the trajectory overall is clearly to the downside. You're looking at a long-term downtrend. Now, this actually started more or less, if all the way up here, but in more recent times, you could probably say from 2011, as we eased out of the financial crisis, where you had the dollar have a real roller coaster. In 2008, it gained value, drops, drastically. The New Zealand dollar drops, the US dollar gains value, and then it loses all its value, sacrifices all those gains as the global economy recovers, and people stopped buying the dollar at that point. And ever since, you've had your fall in the New Zealand dollar again. So essentially, financial crisis comes, people buy the US dollar and the New Zealand dollar falls, and then they get rid of the US dollar and the New Zealand dollar rises. So that's as things start to get better. But after that, as time has gone on, you've seen that the US dollar has regained its value like it has for a significant period of time. So you're dealing with an overall downtrend. So the first thing off the bat is to understand that this is a lower low. Okay, this low here is a lower low from this level that I'm now going to highlight. Okay, but this last low is not a lower low. And what actually happens is it stops early, okay, and very much in line with your previous candle wick. That is as the larger money in the market and professional traders alike are saying, okay, well, we're going to get a cracking deal if we get long here because the price hasn't been this low for 2 years. Okay, you had that drop there in 2020 March, and you return to that same area in October 2022. Okay, so you've got a good couple of years there, 2.5 years almost. But nonetheless, if the trajectory does continue, which is a downtrend, you may expect in the future that you're going to come around this key level here. Now, this was really important because that was where traders decided that we wanted to liquidate their short entries, and it would be very much ideal as a long entry zone. And that's absolutely what you had. You had this massive price rejection from this area as people loaded into the long side. Again, it was professional traders, institutions alike. All the people who make money are very good at identifying what is an ideal price and where the real crux of things is going to go. You can see you had the same thing around here. Okay, so they know where people are going to shove their orders in long, and then hence you get a higher price. You actually had the same thing over here as well, if you can see it. So these things repeat very clearly. So therefore, if you do end up with a lower low and it brings you in line with this previous level from 2009, that is going to be a very ideal long zone. Because if you look what has happened before, you've seen the price rally there before. So you know the price of 0.50, 0.5 area is an area that is respected by traders as a long entry. And you know that because you saw that previously. So if it does turn out that you can get there, that would be ideal. I would say you may get another jitter in line with this previous level of 556, and ultimately, as a second level of DCA entry, I would prefer it near a 5.2. So I'm spacing my entries out very much. Okay, you can see 0.5 to 0.52 area, and I'm giving the market a chance. The most recent push up on your longer term trend brought you straight to these key moving averages, and it has brought the market straight back down immediately, okay, to where you are now. Now, this pop-up is ideal for reshorts, but they must be light, because if you look previously, the pop-up from there took you several months in the future. This one took you 2 months. You're only really on month one for a pop back, and you're not even at your earliest key moving average, which is here. I'm going to zoom in to analyze short entries in a second, but I'm just using the longer term time frames to identify long entries, because it's the only way really to do it. When you've had a market that has slidden for such a long period of time, it's better to be using higher time frames to identify long-term areas, because this is a long-term market if you're buying. It takes a while to get to these points, I know. That one took from 2014 to 2015, so there's a year there. This one, 2017 August to 2020, so a couple of years, so 3 years. And then you had 21 to 22, so another year, okay? So it may be the case that from Jan 23 to Jan 24, you may find yourself lower under here. If you're going to look for entry one, I would make it light. You've hit that level several times already, and you haven't had a far bounce from it. So there's clearly that short side bias for the New Zealand dollar. I would expect a lot to change in the near term. The reason why you've seen a local push now lately is because you had your US inflation. But nonetheless, you can see this very early rejection there. I think that's a short zone, but very, very lightly. It comes in line with early MAs and your early resistance, which you can see running all along here. So light shorts may be applicable at this point. In the longer term market, should you get a much larger rebound, and again, it's probably going to be good to see what happens in terms of monetary policy in the respective economic zones, New Zealand and the US. You may find that it's more ideal to short higher up 0.64. So give the market a good bit of room. I would say the less risk averse zone to get short is in your near term area where you are now. I've entered very light shorts, but as you start to appear to get nearer to these higher MAs, 40, 100, and eventually your 200, I would consider changing your size, because I would say you've got a more probable entry at that point. At the moment, you're very early on. You're still on a very low price. If you put your time frames up to something like the 12 monthly, you can see you're 3 years down now. So do you really want to be selling those lows? It's very debatable. If you look back, the last time you saw 3 years and then a push up, you had one there, but anything longer than that was all the way back at the start of the millennium. You've not had 3 years or 4 years, let's say, of down movement. So I would be careful on that front, just shorting lows, because if you're shorting lows in a long-term market, you've really got to be careful. So from a pure technical bias, I would say you've got much better entries down here. Okay, much, much, much lower, nearer 5.2 to 5.0. I would probably skip buying this level if you're risk averse at 0.552, because you may find that it does not withstand itself that much, because you had a very weak push the previous 2 times and it's got lighter. I mean, if you look, that fall is greater than this one, and the rise is greater than this one. So it's getting lower and lower and lower. That would be your short zone. If you are looking to short in the future and you're looking for an ideal price, in my opinion, I would do it in line with this long-term downtrend. I would do it in line with your key moving averages. That would be something probably along here within your 100 and your 40 MA. Really good tech zone, various levels of price rejection higher up as well. You can see those just around here. Okay, so shorts, 0.67 longs, 0.52 in the very long-term market. Anything nearer, you could get short perhaps 0.6 now and long 0.57, something like that. So just be very careful trading it at all times. You really need to treat this market with care because it's drifting and naturally there's higher risk. Thanks for watching. Hope that helps. Don't forget to get my free training underneath. I'll see you in the next one. See you there.